As of Monday, October 6, 2025, with the U.S. markets in pre-market session, Tesla stock is indicating a slight uptick, hovering around the $430 mark, building on its previous close of $429.83. While the immediate price action appears relatively calm, this surface-level stability masks a significant undercurrent of tension that is redefining the entire investment thesis for the company. Most investors are currently fixated on the record-breaking third-quarter delivery numbers, over 497,000 vehicles, a figure that comfortably beat Wall Street expectations. The common belief is that this operational success should translate directly into sustained stock price appreciation. However, the reality is far more complex and, frankly, more precarious. The market's initial positive reaction to those delivery numbers was fleeting. The stock rallied in early trading on the news before closing down significantly. This reversal wasn't a random fluctuation. It was the market waking up to the fact that a large portion of those sales were likely pulled forward by customers rushing to claim the $7,500 federal EV tax credit before its expiration at the end of September. The real story isn't the record number. It's the looming demand vacuum in the fourth quarter and beyond, a reality that the headline figures conveniently obscure. This creates a fascinating dynamic for anyone invested in or watching Tesla stock. On one hand, you have a company firing on all cylinders operationally, setting new records for both vehicle deliveries and energy storage deployments, which hit a record 12.5 GW in the last quarter. On the other hand, the very catalyst that drove this recent success has vanished, leaving a significant question mark over near-term growth. Many investors using platforms like Robinhood or Fidelity for their self-investing strategies see the delivery numbers and think it's a clear buy signal. They are looking at the surface-level data. But the institutional players, the ones moving significant capital through brokers like Interactive Brokers, are looking deeper. They are modeling the impact of the tax credit's expiration, and that model suggests a potential slowdown. This divergence between the retail expectation and institutional reality is where the current volatility is born. The narrative everyone accepted, that production growth equals stock growth, is now being challenged by the stark reality of incentive-driven demand cycles. This is a critical juncture for the stock, a point where the prevailing bullish story collides with a more nuanced and potentially bearish short-term outlook. Digging deeper into the recent market activity, the trading volume on the day of the delivery announcement was immense, topping 133 million shares. This high volume, coupled with the price reversal, signals significant institutional distribution. In simpler terms, big players were likely selling into the retail buying frenzy that followed the positive news. This is a classic pattern that often precedes a period of consolidation or correction. While many retail investors on platforms like SoFi Invest might be celebrating the headline figures, the smart capital is repositioning itself, anticipating a tougher road ahead in the fourth quarter. It's essential to understand that the market is a forward-looking mechanism. The record Q3 is already priced in. The battle for Tesla stock's direction will be fought over the guidance the company provides for Q4 and 2026 during its upcoming earnings call on October 27th. Analysts are already forecasting a potential year-over-year decline in earnings per share for the third quarter from $0.72 to around $0.52, even with slightly higher revenues. This expectation of shrinking margins despite higher sales is a core part of the bear thesis and something every investor needs to be watching closely. It speaks to a broader trend of price cuts and increased competition that is beginning to weigh on profitability across the entire EV sector, a factor that many bullish narratives tend to conveniently ignore when focusing solely on production volume. The company itself, of course, is more than just a car manufacturer. Tesla is a collection of ambitious projects, and the weight investors assign to each of these projects is constantly shifting. This is where the story gets even more interesting. While the automotive side of the business faces near-term demand questions, the narrative around full self-driving and the robo-taxi concept is gaining significant traction and becoming a primary valuation driver. The company is on the cusp of releasing FSD V14, an update that Elon Musk has claimed will make the car feel almost sentient by version 14.2. This isn't just a software update, it's the linchpin of the bull case that values Tesla not as a car company with a price-to-earnings ratio in the dozens, but as a technology and AI leader with a valuation that can justifiably stretch into the hundreds. The initial rollout is expected today, and the real-world performance of this software will be scrutinized intensely. Any demonstrable leap in capability could render the concerns about quarterly delivery numbers almost irrelevant. Conversely, if FSD V14 fails to deliver on its lofty promises, it could remove a key pillar supporting the stock's current valuation, leaving it exposed to the harsher realities of the automotive market. This is the central tension at the heart of Tesla stock today, the tangible but potentially slowing reality of its car business versus the intangible but potentially enormous promise of its autonomous future. Your entire investment strategy depends on which of these two forces you believe will win out. For those utilizing Schwab Intelligent Portfolios or similar automated investment platforms, this is a factor that algorithms may struggle to quantify, highlighting the importance of human oversight in any investment decision involving such a dynamic company. From a business model perspective, Tesla remains a uniquely vertically integrated entity. It not only designs and manufactures its vehicles, but also operates its own charging network, sells energy storage solutions, and is developing its own AI hardware and software. This integration provides significant advantages in terms of control over the user experience and potential for higher margins. The company's main products are the Model 3 sedan, the Model Y crossover, the premium Model S and Model X, and the more recent Cybertruck. The vast majority of its record deliveries were composed of the Model 3 and Model Y, highlighting their importance as the core drivers of revenue. The energy division, while still a smaller part of the overall business, is growing rapidly and represents a significant long-term opportunity. Past performance has been nothing short of spectacular, with the stock delivering incredible returns for early investors. However, as the company matures and the EV market becomes more crowded with offerings from legacy automakers and new entrants alike, the days of exponential, uncontested growth are likely over. The challenge now is to transition from being a disruptive startup to a mature industrial giant that can sustain profitability in a highly competitive environment. This is a transition that many high-growth companies struggle with and represents a key long-term risk for investors. Looking ahead, the future outlook for Tesla is a landscape of immense opportunity fraught with significant risk. The primary catalyst, without a doubt, is the successful development and deployment of a truly autonomous robotaxi network. If Tesla can solve autonomous driving, the total addressable market expands from simply selling cars to capturing a share of every mile traveled globally, a multi-trillion-dollar opportunity. This is the expectation that underpins the most bullish price targets. The reality, however, is that solving Level 5 autonomy is an incredibly difficult technological challenge, and regulatory hurdles will be immense. Delays or failures on this front represent the single greatest risk to the long-term investment case. Another key catalyst is the development of a more affordable next-generation vehicle, often referred to as the Model 2. Such a vehicle would open up a much larger segment of the market and could reignite volume growth. The risk here is execution and timing. Competitors, particularly from China, are moving quickly in the low-cost EV space. Comment below with your thoughts on whether you believe Tesla will be the first to achieve full, unsupervised autonomous driving on a mass scale. On the risk side of the ledger, the macroeconomic environment cannot be ignored. Rising interest rates make financing a new vehicle more expensive, potentially dampening demand. A global economic slowdown would also impact consumer spending on big-ticket items like cars. Then there is the ever-present geopolitical risk, particularly concerning Tesla's significant manufacturing presence in China. Any escalation of trade tensions between the US and China could have a severe impact on the company's operations and supply chain. Competition is another major headwind. While Tesla had the EV market largely to itself for years, that is no longer the case. Nearly every major automaker has now launched competitive electric vehicles, and they are investing billions to catch up. This increased competition will inevitably put pressure on pricing and margins. An individual brokerage account holder must weigh these risks against the potential rewards. Services like Fidelity Wealth Management often construct portfolios that balance